Welcome to this class of Advanced Taxation. My name is Patrick Kamau Kamure, where we continue learning more about taxation of the business income. So far, we have been able to look at some aspect of the taxation of the business income. And we said the businesses that we want to see how they are usually taxed is the partnership and the limited company. And we say that in the taxation of any kind of a business, there are very important areas that you must be able to first of all get before now you move on to the year taxation. One of those areas is number one, determination of the taxable incomes, where we saw that there are two approaches or methods which you can use to get that taxable income of any kind of a business, whether you are talking about the partnership, whether you are talking about the limited company. And approach number one, we talked about the gross profit method. And under the gross profit method, we were able to see about the determination of the taxable income for a trading business and also for a service business. Approach number two is the net profit method. And we saw when you are supposed to use the net profit method. After that, we move to a very important area, being able to distinguish between incomes, the taxable, the non-taxable incomes, the expenses, the allowable, the non-allowable expenses. Now, we looked at all this. Now, in the process of dealing with the allowable expense, we saw that there was an allowable expense that we called capital allowance. And we say capital allowance is usually granted in place of depreciation for the cost of fixed assets. So we want to learn more about this capital allowance. How do you normally determine the rate that you're supposed to give a particular item? Which item qualify for which capital allowance? So welcome to today's class of the capital allowances. Now, as we have said, capital allowance granted in place of depreciation. Why in place of depreciation? Because we said depreciation is usually a non-allowable expense. And depreciation is usually for the accounting, is for the accountant. And we saw that they normally use it when they are getting their accounting profit, which we don't usually use in taxation. So in place of depreciation, in taxation, we normally use the capital allowance. And it is usually granted on the cost of fixed assets, or what we call the capital expenditure. Capital expenditure are the expenditure which, when they are incurred, the benefit out of that item is usually realized over a long period of time.